Out there in risk parity land. This is Justin from Risk Parity Chronicles, bringing you a new video titled How to Read Withdrawal Stats in a Backtest. All right, so this is the third in a three-part series on withdrawal rates. If you've been paying attention to the blog, last week I started off last Sunday with a post on why withdrawal rates matter, especially in decumulation portfolios, and why it's better from a risk parity perspective to sort of focus on their strength in terms of withdrawal rates instead of compounded annual growth rate, which is better for accumulation portfolios. I followed that up midweek with another post about sort of the two main withdrawal rates, well, at least the two that I know of. There might be others, but safe withdrawal rate and perpetual withdrawal rate, and why I rely more on the perpetual one. This post is the third in the series, and it's a practical look at backtests and how to use and interpret the withdrawal stats on them. So I'm going to use a backtest from Testfolio. I'll walk you through the withdrawal stats and what they mean. This is a super important skill for DIY investors to be able to know how different portfolio choices change your ability to withdraw from that portfolio. It's also further proof about why, at least for me, risk parity is a great investing approach. Not necessarily the best for accumulation, but when it comes to decumulation, having a resilient, diversified portfolio really does make a difference. And we'll see a prime example of that today. So I encourage you to read all posts in the series. Did want to back up just in case someone didn't and they started watching this video anyway. I just mentioned safe withdrawal rates and perpetual withdrawal rates, and really important that we go over the distinction between them. Safe withdrawal rate is how much you can take out from your portfolio and still finish with more than zero. So it's just keeping your head above water, never running out of money. Perpetual withdrawal rate, a little bit stricter. It says how much you can take out and never dip below what you started with. Now there's some caveats about that. You don't really have a perpetual withdrawal rate for 5, 6, 7 years because you could always start off with money on Monday and you have a bad market day on Tuesday and you're already down. So there is a little bit of a buffer with the perpetual withdrawal rate. They don't really apply for very short time frames, but we'll kind of walk through and these concepts will come up. So there you go, safe withdrawal rates and perpetual withdrawal rates. All right, let's now go to the back test. All right, so what I've done is I'm going to back test two portfolios, one accumulation and one decumulation portfolio. Before I go down to that though, let me just put this in here. Make sure that this box is checked. Okay, now I've shortened narrowed my screen a bit, so usually it's over here on the right side, but it's a little bit moved down there. Make sure that is checked. That's going to give us some cool stuff later. Okay, so here are the two portfolios I put in. I put in a version of my equity triangle that you can read about on the blog, and that's just three equity tickers: S&P 500, small cap value, and international, each held at about a third of the portfolio. And then I'm going to compare that with a decumulation portfolio, the golden butterfly, with 5 sleeves, each at 20%, S&P, small cap value equities, short-term bonds, long-term bonds, and gold. All right, so hit the back test. Boom, I think I already did that, but here we go, do it just in case. And back test complete. All right, okay, now we've used sim funds here, so we have 56 years of data. That's pretty awesome. Okay, so right off the bat, we'll just check the withdrawal stat, not the withdrawal stats, we'll check the summary. And you can see here that the annual growth rate for the equity triangle has been 1.33% higher than for the golden butterfly over the past 56.08 years. Now, that may not seem like a lot when you come to this here, but of course, when you look at the ending value, it's a big, 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 big difference. So 4.45 million versus 2.4 million. Okay, so this is a case where, like I've said before, if you're in the accumulation stage, I don't know if risk parity is for you. Certainly, there's principles you can adopt, but in general, you're better off with just taking on as much equity risk as you can handle and just going for it. Okay, so you can really see here that in the accumulation stage, there's really no substitute for just a lot of equities. Okay, and you can see that here. So that's not the whole story, though. If you're reading the blog, you have somewhat of a different perspective, hopefully. And for that, we're going to look at the withdrawal stats. So I go here, and now First thing you see are these cool curves. Now these curves are super interesting. I'm gonna come back to them, but I think they make a bit more sense when we have gone over the details, and then you can kind of see what the curves represent. So I'm going to go here. We have 56 years of data, so really we can do any of these. And also I'll explain as we go, and as I explain in the blog, I like to use 25 years, and I'll come back to that. And basically what this is a rolling window. If the first day was December 31st of 1969, you're going to take that path that started that day and ended on December 30th, 1984, right? If my math is correct. Then you're going to take January 1st of 1970 and go till December 31st of 1984, and then so on and so forth. You're going to, is that right? Yeah, you know what I mean. So you're going to keep going in these 25-year blocks. You've got about 250 market days, and the number of years is going to be, what, 56.08 minus 25 plus 1. So you're looking around 8,000 paths for this test. But it's not, strictly speaking, a Monte Carlo. It has kind of the same effect. You get lots and lots of data, but this is not a randomized Monte Carlo simulation. It doesn't have quite as many as Monte Carlo. Okay, so there we go. We got 25 years. We're going to put our two portfolios side by side, and we're going to get 4 different sections of data. I'll go over each one briefly. First one is your safe withdrawal survival analysis. This is going to be, again, safe withdrawal rate, how much you can take and still make it, still end with more than 0. And pretty great numbers for both portfolios here. 100% of the observed pathways in over those 25 years, within that 56 years, 100% survived at 5%. 100%, of course, are going to survive at 4, 3, and 2. Likewise for the golden butterfly. So you have here that both of these portfolios have been fantastic over the past 56 years for any 25-year section that you want to take. Now over here on the right, we have what's called the terminal multiple, and that's what that TM is for. It says if you did take 5%, for example, from your equity triangle portfolio, your average ending balance would be 3.57 times what you started with. So if you had $1 million, you would wind up with 3.57 on average. Okay, that's going to go up, obviously, as you take less and less from the portfolio. And you can see that, sometimes you may have seen on YouTube that if you take 4% from a portfolio, you're way more likely to wind up with triple your money or quadruple your money compared to running out and going to 0. But here you can kind of see how those numbers look. All right, so that's safe withdrawal survival analysis. Now we're going to make it a bit stricter. I'm going to go to the perpetual withdrawal rate. And for that, now not only do we need to end with at least 0, we need to end with, we need to have at all times more than we started with. So in this case, you don't have quite the same level of success. You're still pretty darn good though. So 5% at that withdrawal rate, 89.2% of equity triangle pathways would have been just fine, but a bit more for golden butterfly, 94.3. And as you go a little bit lower, you're going to see 100% success rates for those. And again, the terminal multiple going to be, once again, some strong numbers that if you did take out 5%, even under the perpetual withdrawal rate, you'd still wind up with almost 4 times as much of your money. Okay, let's go to the next one, safe withdrawal rate analysis. I find this one and the bottom one a little bit more useful. And in fact, I do kind of wish they had put this third one under the first one and the fourth one under the second one. I wish they had kind of adjusted that. But anyway, this is just the actual rate that at 100% survival, meaning 100% of all cases made that, you're finding the absolutely worst case scenario, and what was that number? And every other scenario is going to be higher. So this safe withdrawal rate is saying that the lowest or the most that you could take out with 100% of the cases still surviving would be 5.51% of an equity triangle. But here, look, our risk parity portfolio has done more than 1% better, so 6.6. If you took that out of golden butterfly portfolio over a 25-year span within this 56 years of data, you could have taken out safely 6.6% and wound up with at least 0. You can see here the terminal multiples are going to be still quite high. And if we're willing to go down a little bit on our confidence level, go to 90% survival rate, we're getting all the way up to 7 for that, and leave 6.3 for the equity triangle. Okay, so that's the safe withdrawal rate analysis. let's make it a bit more conservative. Now let's go to the perpetual withdrawal rate. And here you see that we can still take out quite a bit. So we could take out 4.41% from a golden butterfly portfolio over a 25-year span, any 25-year span within the past 56 years, and we would have been okay at that rate. As we lower our our strictness level, or we allow for a little bit more realistic and not quite demanding that perfect scenario, we can get it all the way up to 5.2. So that's your perpetual withdrawal rate analysis. This last one is the one that I think is really the gold standard. And when you are looking at withdrawal stats, this is one I would go to the most. Now, let's go to the next little thing. You see here I put in 25 years, and I encourage you with the link attached to go and kind of see these. Now, you're going to get some anomalies depending on the year and depending on what you're talking about. But in general, if you go over here to 35 years, you're going to see that for survival rates, they're a bit lower. And for perpetual withdrawal rates, they're a bit higher. I'll explain a little bit more of that in a second. But as you lengthen the time period, perpetual withdrawal rates actually increase after that initial 5 or 6 or 7 years where it's at zero. After that, they start to go up. Safe withdrawal rates decline over time. And what's produced is a curve, which I'll show you in just a second. But here you can do 15 years. You can kind of see, again, it's not going to be not going to be perfect every time. There are some stretches where, again, if you need 100% assurance, it just takes one bad pathway to really lower that, or to create some kind of disruption. But in general, that's what you're going to see. If you lengthen the time frame, your PWR will go higher and your SWR will go lower. And here is what that looks like. Okay, so this is the golden butterfly. I do wish we could put on both portfolios at the same time, but we can't. And anyway, we get this wonderful curve. Okay, so you can see here that I've chosen 25 years, and that's about the rate, about the time where this curve really starts to flatten out. Okay, so you see here that with your safe withdrawal rate in blue, starts off really high. Obviously, if you had only a safe withdrawal rate for a year, you could take 100%, right? And it goes down quickly, and then it kind of starts to flatten out around year 25, year 30 in there. We don't get much change. The perpetual withdrawal rate, you notice, doesn't start over here at zero. Or at the 0 year. It really takes 5-6 years to get to a place where it's comfortable, and then it starts to climb and goes up again. Again, around 25 years or 30 years, we have a bit of a flattening out, and you don't get that much change over time. So you can see that there. You can compare the golden butterfly here to the equity triangle, and you'll just see that rates tend to be a bit higher for safe withdrawal rate, but your perpetual withdrawal rate is going to actually increase as you lengthen it, which in some ways is more assuring. Okay, so those are the curve charts. I guess the last thing is just to kind of wrap up with some of the big picture from this. It's a great back test for showing you the power of risk parity and why in a decumulation phase, withdrawal stats are more important than CAGR. So here again, there's no doubt that equity triangle is better for CAGR, but if you're looking at how much you can withdraw, a reasonable rate, you just have a more resilient, a stronger, more diversified portfolio that will allow you to take out more money that you can actually live on with a greater chance of success. So that's point number one. Point number two, you kind of see here why I prefer the PWR, the perpetual withdrawal rate, over the safe withdrawal rate. A couple reasons. It's just a little bit more conservative, okay? And mainly, one of the big problems with the safe withdrawal rate is that if you don't know how long your retirement is, because you don't know how long you're going to live, that number decreases over time. Now, granted, at the 25-year time frame, it really doesn't decrease all that much. But you still kind of see that if you overshoot, or if you live longer than you had thought, that number actually that you had taken out early would have proven to be overly optimistic. But the PWR is a little bit different. If you live longer and your retirement stretches longer, well, actually, you're even more certain than the rate that you were using is going to be safe, because that number actually would be higher for a longer period of time. And the last point I want to make, I haven't really dealt with this on my blog very much, but you hear a lot about the 4% rule maybe not being the best, that maybe be too optimistic. I really like the work of Ben Felix, for example, but he sometimes talks about 3.3 or 3.4% being being the rate that you can take out. Wade Faw, another kind of big name in the space, he did a paper saying 2.8, and it's just one of those things where I hear what they're saying, and I'm really interested in what that number is. But every time I run the test, I don't usually get a number that's under 4. And if I have a strong portfolio, a risk parity portfolio, I almost always get one at 5 or even 6, sometimes even 7%. I think that having a better portfolio is a way that you can really add, say, 1% to any kind of withdrawal rate that you might be thinking of. Or if you don't add to it, you're just going to add to your confidence that whatever withdrawal rate you do have will survive. So yeah, I'm still open to the fact that I'm totally wrong on these withdrawal rates, but every time I run the numbers, whether it's Testfolio, whether it's Portfolio Visualizer, whether it's Portfolio Charts, whether I do 56 years of data, whether I do 30 years of data, whether I do 15 years of time frame, whether I do 30 years of time frame, I just get numbers that are usually quite well north of 4%. So again, how much you want to take out from your portfolio is of course up to you, and I don't know if there ever will be any number where we can look at the past and determine what the rate for the future should be. That's just not something we can ever determine. But it just seems to me that some of the 4% stuff is wrong, but maybe not for the reasons that people often think. It's not that it's too high, it's that it's probably too low. So anyway, those are my thoughts. I do encourage you to read the blog post for more, and let me know if you have any questions. This has been the third post, so it's been kind of fun to really dive deep into this. If you have any questions, let me know. I'm thinking about maybe doing a FAQ post kind of thing coming up, and can answer any questions you may have. Okay, thanks a lot. Bye-bye.